Total has been one of the most resilient oil majors out there, yet you have the smallest shale presence of all the European majors. What's the thinking?
There is no link between resilience and shale, let's be clear. I can tell you, shale is a quite capital-intensive activity. But having said that, it's a question for me where the Total is the most efficient, in fact. I have some competitors which obviously have some legacy of assets in the shale, and all that's a matter of allocation of capital. And when I'm allocating capital, it's not an infinite. I have to allocate it where I can add value for the investors. And Total has some strengths, Africa, Middle East, North Sea, deep water, LNG, and I prefer to play to my strengths, to develop the company, to be the leader in each of 5 segments, rather than just trying to fill the gaps. And shale for Total, if I'm coming, it's not to produce 50,000 barrels per day and to tick the box. It would be to be much larger scale. So that today, cost of access is expensive, and I don't have the human resources for do that. So there are plenty of opportunities for Total, and in 2017 we have made M&A in Maersk Oil acquisition that we will close this week, or the LNG portfolio NG, which I think are more efficient to create value for investors than Shell. Again, it's not against Shell, it's just towards my position, my strengths, and this is the way we want to develop the company.
But if the next phase of energy development is going to be short cycle and efficiencies, those two don't really match up with things like North Sea oil, Gulf of Mexico, offshore deep water.
This is a fashion that, by the way, we are the most efficient today. Do we have Shell? No. Do we have short cycle? Yes, but short cycle, what does that mean? It's not Permian, which is short cycle. Short cycle means that you are able to turn off some capex quickly. So it's a matter of contractual arrangements. It's not a matter of what you produce. So in Total portfolio, I have plenty of conventional field offshore, but by the way, in 2015, with the downturn, we turned off plenty of capex by stopping to make infill wells in mature fields. So I have 1 billion barrels in my portfolio which have been turned off. I can't turn them on. It's all a matter of contractual arrangements. So this idea that short cycles are linked to Shell, that's not true. And by the way, for a major company, I'm not a small independent trying to make money over a 6-month well because I have aged that well at $60 and then I turn off. Objective of a major company of the size is to be able to ramp up the production to a plateau level, which means, in fact, in Shell, and we have an operation in the Barnett Shale where we have 1,800 wells, but we accumulated these wells, and it's not by short cycle that we've done that. It's 10 years of capital investments, $12 billion have been invested in the field today to have a bunch of wells which produce a plateau level of 600 million scf per day. So I think that this is something which for me, it's just a matter of wording, but reality is that you can be very, very efficient, and we demonstrated it. Total is today the most profitable major company without any share.
Nonetheless, Gulf of Mexico isn't something that you'd wind up hearing associated with things like a lot of growth and efficiencies. So what's the opportunity set that you see in Gulf of Mexico, and what kind of costs might you see declining?
Gulf of Mexico is back to deep water. This is a strength for Total. This is why we are stubborn, For many, many years, we are investing, exploring in the Gulf of Mexico. We have announced that with Chevron, we've made a giant discovery in the eastern part of the Gulf of Mexico, Baltimore. Very happy to be there. So obviously, but deep water is just a matter of size. Like in Brazil, if you have more than 600 million barrels of reserves, you will be as efficient in your capital expenditure and operating expenditures because it's a matter of amortizing the greenfield installations on a large size of resource. If you have 250, 300 million barrels, which is often the case in the US, then you have to find the tiebacks, infrastructure, in order to avoid to make a greenfield development. So all that is a matter to find the right way to develop the resource, keeping in mind that my priority, the priority is to have a low break-even, because then if you spend too much, and the mistake we've done deep water when the barrel was at $100 per barrel was to make greenfield development with big platforms on smaller reserves. This is not competitive. So a lot of lessons have been drawn. So I can tell you, yes, Total, Gulf of Mexico, it fits well, deep water. And by the way, we like to develop a company in the US.
What is your average break-even for the company and then for the deep water?
The break-even is for the company was $27 per barrel last year. before dividend. After dividends, it's around 50, so 27. And the deepwater, we just sanctioned Libya in Brazil with less than $20. So all that is a matter, again, of capex efficiency and size of project development.
And how much of that is the size of project development or some cost efficiencies that are still being run out because offshore was way behind where shale was in terms of lowering costs?
But it's not true that Shale. Stop speaking about Shale like it's a new Bible. It's not true. I'm sorry, it's not true. Again,
can you say that in Houston? Is that
I can say that in Houston because I have the proof. We are producing shale gas in the Barnett shales, not far from here. We spent, Chesapeake spent, because we buy back their shares, $12 billion to produce today a stable plateau of 100,000 barrels per day equivalent. I can tell you it's very capital intensive. So, again, I'm not against. I think shale is a good resource. It will be developed. I'm sure that more shale oil will come in 2018, $65 per barrel. You can develop the Permian. All the shale oil is not same cost, but it's not true that it is the lowest barrel in the world. The lowest barrel in the world, you know where it is? It's in Saudi Arabia, it's in Abu Dhabi. This is where Total invests, by the way.
So
there,
yeah.
I can develop barrels for $5 per barrel. Can you do that in the shale? I'm not sure.
I haven't heard 5.
So again,
I think I've heard 13,
we need all of that. We need all of that. We need all this resource. We need all this oil. So there is no incompatibility.
Well,
what we don't need is to develop very expensive oil in Alaska or not in Alaska, in Arctic regions.
Yeah.
That you will not see Total exploring for oil in Arctic areas. It doesn't make much sense.
So what we've all been waiting for in the oil community is when that supply crunch is going to come, where you wind up from the capex that wasn't spent over the last few years, all of a sudden decline rates are going to explode. We're not going to have enough oil. Do you see that being an actuality? And if so, when would that be?
When? That's a big question. Nobody knows.
Everyone's been saying it for years and it hasn't happened.
Did you announce in Bloomberg that the barrel will be $71 in February? 2 months ago? No, nobody announced it. No. So there is a huge volatility. So what I'm convinced, what is true, is that since 2015, we have lowered the world capex from $700 billion to less than $400 billion. The market has decreased by 30%. So there is, but it's not enough. We have largely diminished the volume of investments. And when you don't invest enough, 4 years in a row, in 15, in 16, in 17, 18, the capex announced are the same. This will have an impact. But in this industry, it takes 4, 5, 6 years, before to see the impact. And we are not able. So, of course, the shale are giving a capacity to, and I think the increase this year is a barrel remain at 65. You will see 1.2, 1.3 million barrels of oil additional production coming from shale oil. It's for this point, you can mobilize more oil quickly. But in the long term, even if you think that you will go from 10 to 15 million barrels of oil per day, as this industry, we have every year a decline, natural decline of 3, 4, 5% per year. After 10 years, we will have a lack of capacity. That I agree. So when? No, it will be too easy.
But does that lack of capacity mean we're going to see triple-digit oil again, or do you think that the industry is much more disciplined and much more flexible now than it was?
I think everything is possible. Look, we were in August 17 at $42 per barrel. We increased to 66, 68. 50% of volatility. Imagine that tomorrow you have huge sanctions again on Iran and Venezuela. You get off 2 million barrels of oil per day of the market. Don't you think you will see an increase? So I think this idea that there is a ceiling, a floor, except that 100 is a round figure, everything is possible. What I also think is that you have cycles, and that's even if we go up, we'll go down one day.
And
so in terms of capex discipline is fundamental. So this is for me is a big lesson, and this is why Total has announced, by the way, that if we have higher revenues beyond $60, we will do some share buybacks because we want our shareholders to benefit from the additional revenues, and it's a way to implement some discipline in the way we allocate capex. So Total, I think, has a program to invest $15, $17 billion per year of capital investments, organic capex, and some M&A. That's fine. With that, plan is to grow by 5% per year. So we can do that. And of course, you could have some inflation, which will impact. But I think one of the lessons I draw is that in this commodity business, the best investment policy is a sustainable policy, which means trying to keep more or less the same level of investments. Do not overinvest when the price is high because you have too much money, and do not underinvest. So the best way then is to return money to shareholders if you have too much money.
And you just put some money to work. Last week, you bought $450 million in assets in Libya, right?
Yeah.
And then all of a sudden, over the weekend, Libyan production went offline because of some issues there. How do you understand, and why do you want to take on that geopolitical
So
risk?
you think it's not a good deal? It's one of the best deals I've ever done.
I'm not saying it's not a good deal. I'm saying, how do you understand the geopolitical risk in that environment?
There is a risk in Libya. You know that. I know that. We are not naive. We know that this country, unfortunately, is in a war, but we also know that there are forces, and that it is in the interest of the country to be able to produce as much as they can. Having said that, if we manage to make that deal, it's because of that situation. We managed to convince Marathon, because Marathon wanted to exit from that risk, and because of $50 per barrel, they prefer to invest their money in U.S. shale, So that's good. So there is somebody like Total, we are ready to take risk. What is $400 million for a company? We have $150 billion assets. It's nothing, let's be clear. So what I'm sure is that this, having access to this concession, which is plenty of resources potentially, is a good bet for the future. So yes, immediately. But we didn't plan for that. When we announced 5% growth, we didn't plan to have that there. So it's an additional, it's extra cash that will come to the company. So that's part. I don't choose where you find oil and gas in that world. It's where it is. Unfortunately, sometimes it's in nice countries, like Shale oil in Permian, even if you have plenty of class action and lawyers and massive things, and you have Libya. So you have different risks everywhere in the world. There is not a perfect, quiet place. It does not exist.
So just to wrap it up here back in the U.S., we've heard a lot of talk out of D.C., potential tariffs, 10% on aluminum and 25% for steel imports. How do you think about that as a CEO of a major international oil company that invests in the U.S.?
I think it's, globally speaking, I'm against all these commercial wars. I think there is a political problem issue, globally speaking, not only in the U.S., everywhere in the world. We observe that in Europe, look at the results of the Italian elections, France escaped. But I think there is a problem, but is this globalization is rejected somewhere. But in fact, it was quite positive for many people around the world. So I cannot be in favor of putting walls. I think it's better to try to build bridges. I think, we face that with the solar. I'm directly concerned because we are shareholder of SunPower, a solar company, a U.S. solar company. By the way, the irony is that U.S. has put some tariff on the solar because of two companies. One of them were held by Chinese shareholders. I don't know if the President Trump knew that, but he's just put a mess in some U.S. companies because of some foreign companies which complain about, which is a little strange. The result of that, what happens in the solar industry? Not only SunPower will solve these issues, but globally the solar market will drop. And I think on these steel and aluminium, the supply chain today is organized through countries, from Mexico, Canada, US. So car manufacturers, all these guys, they have optimized the supply chain. If you put tariff, what will the results? At the end, the customers will have to pay.
And the customer might be you if you're talking about a pipeline, right? Does that worry you?
I mean, I can weather the storm, and it will not affect like that. The question is the end customers, the voters, the people who elect. And I'm not sure you create more jobs. Again, in the solar industry, you don't create jobs by manufacturing cells in the U.S. It's very little number of jobs. You create jobs because you have plenty of distributors, people who install the solar panels on the roof. These create jobs. So this tariff, which in fact have just a negative impact on the global market, at the end, the question is, will it really create jobs or destroy jobs? I'm convinced, I know President Trump is convinced of the country, and again, I'm convinced that it's not good for the U.S. economy, that it will damage. It's not good for the world economy. So again, I don't see, by the way, as a CEO of a global company like Total, could be in favor of building walls. I think all the peace in this world will come because we are able to build bridges, not walls. It's not true.
The last question I have for you. If you were to look at Total, what's the biggest thing you're unhappy about with Total right now, and what do you want to fix this year?
I'm very happy with Total.
You have to have one thing that's kind of in your mind that you're like, I really want to work on this year. I'm not so happy with that.
Simplification in the company. Our global corporations are complex. I can tell you, because plenty of regulations. So we work on simplifying the company, the way we process, agility, flexibility. And the second point is being able to be more visible in our engagement with the society. I think fundamentally, if we want to maintain the business model of global corporations like Total, we cannot just say we pay taxes to states, we have done our duty. I think the society is expecting more from us. So we need to demonstrate our utility, that we are useful for the people, so that we avoid at the end reactions of closures, of protectionism, which are not the future of the world. Protectionism will lead to wars, and I don't expect that for the world.
Thank you very much. Really fun to talk to you, Patrick. Thank you.